I profited $4,677 in just 5 weeks selling options using just $24,500. And today I want to share with you exactly what I did to get this high return. First up, it's not financial advice. This is just what I do. Don't copy us strangers on the internet. Do your own research, get educated, and make your own decisions. So today what I want to cover is the one stock that profited me 4,600 and turns out it was actually $77, even though currently the stock is down, what anchor positions are and why every account should have them, what makes a good anchor. And this is the important part, the number one skill to master for profitable sold calls. This profit that I received here, it's out of the ordinary because I don't do what typical option sellers do. I tweak things a little bit and I'm going to share that with you. Before we do dive on in, if you are not yet in the 50K club, I would love to invite you into the club. The link is in the description below. This is the place for options traders to create a consistent monthly income without needing a seven-figure account. If you've got a smaller account, the trades you take, the strategies you use, they're going to be different than someone with a seven-figure account. So in the 50K club, I share with you all of the trades I take inside my account, plus we go really deep on strategy as well. And so far, the results have been amazing. In May, just under $5,000. June and July, both months over $3,000 profit off of an account that is $50,000. And so far, people are saying that they love this group far better than others that they've joined, that the community has such a wealth of knowledge and just as valuable as the consistency of information that I share each day. This is all about not just following my trades, but learning how to trade on your own, how to create your own trade plans, and how to make sure that you've got a strategy that works for you and your account. So link is in the description. Come join us, but let's get started. So firstly, what is an anchor? For me, essentially, an anchor is simply a reliable stock position you hold to sell covered calls on. Now, anchors help to keep your risk of your account low. I'm going to show you exactly what I mean in just a moment. And it helps you to produce income week after week after week by selling your covered calls. Now, as far as risk goes, if you hold your anchor long enough, if you play it on the ride up, an anchor position actually works out to be lower risk than even sold puts. I'll show you exactly what I mean. Now, here's the big caveat over the top of all of this. Not all anchors are created equal. Your stock that you choose as your anchor position, it must be upwards trending. It must get good premium. ETFs are great. They got, good premiums, lower risk. And this part is important. It must be a stock you understand. It must be a company with stability and increasing earnings and a chart you can follow. If you have a stock position in your account that's underwater, that is just on a chart going like this, that's not an anchor position. Anchor positions are chosen to be in our account for the long term because we expect them to continue to rise. It's not just a stock position that we end up holding and barely able to sell covered calls on. It's something that's profitable long term. So the other thing with an anchor position is we actually hold this position even if the stock drops. The only way we're comfortable on doing that is understanding the position we're in, right? We're not holding it just crossing our fingers, hoping it comes back. We're holding it because we understand the fundamentals of it, and we understand that the most likely outcome is that it comes back up and it comes back up quickly. As it's dropping, we're continuing to sell calls. And here's the cool part. The more they drop and or trend sideways, the more you make, as long as they come back, right? If they don't come back, of course, we're not making any money. So let me share with you details of my anchor stock. I bought 100 shares at $245 on June 29, and I've collected $4,677 in premium so far. So, guys, that's $934 a week, or just a 19% in just 5 weeks. That's a huge return from doing nothing but selling options. I'm not buying them. I'm not trying to get any massive return. I'm just simply selling covered calls on my stock position. How do I get such high returns? Two things. I've got a good anchor stock and rolling. This is the part that I wish someone taught me sooner, is how to roll. I want to share that with you, and then I want to show you the exact stock that I did this on, because rolling is how I got such high return. If I hadn't rolled, I would be at a much lower rate of return. So let's go check it out. Okay, so here I am in my tracker. On June 29, I bought this stock for $245 a share, costing me a total of $24,500. I immediately sold a 247.50 covered call, expiring 7/2, and I received $970. Perfect. Now here's where the rolling starts. So I didn't wait for it to expire, wait for Monday to come around, and then sell another call. Now these dates are off because I'm in Australia, I live in the future. So if you go and try to find these dates, you'll be like, this makes no sense that you did it on that date. It's technically a day earlier, right? So on 7/1, I rolled up to 250 and out by just 1 week. Now, here's the key. I'm only ever selling covered calls 1 week in advance. I'm not doing this for a month in advance. If I did this a month in advance, there's no way I would be at $4,677 now, right? So I'm only selling week-long calls. So I rolled up to 250, expiring 7/10, received $471. On 7/3, I was like, we're not going to hit 250. We're trending down. So rather than just leave it, I rolled my strike down to 245. I kept the exact same expiry date, and I received an extra $184 in credit. I wouldn't have received that if I just let it expire. Again, I still didn't just let this one expire. On expiry, I rolled back up to 250, out another week to 7/17, received 477. Same deal. Then on 7/14, I was like, we're not going to reach 250. So what did I do? I rolled back down to 240. I received another $395 credit. Do you see what's happening here? This amount here, let me write all these in, because these are amounts that if I had just let the contracts expire, I wouldn't have received at all. On 7/17, I rolled out to the following week at 230. Now, this one I didn't roll again that week because the price started to stabilize. But again, I didn't just let it expire. I moved this or rolled this on expiry, or maybe the day before, technically. So I rolled to the following week, 7/31. I rolled back up to 240, received 641. And then literally a day later, I was like, oh, we're coming back down. So on 7/25, I rolled that down to 230, keeping the same date, for another $288 in premium. Again, that's $288 that I would not have received had I just let it expire. On 8/1, I then rolled that to, I didn't roll actually, this one I did let expire. I think I was away or not really trading. So I let that just go to expiry. And on 8/1, I opened a new position. Actually, because I live in the future, looking at this and figuring it out, 8/1 would have been 7/31. This would have been on expiry. So I rolled that again up to 240, expiry of 8/7, and received 430. Now, what happened to the stock literally today? We got up to 240. So I'm not going to sit on my hands now and go, we're at 240, and I'm just going to let that go, because remember, I'm in this for 245. So I rolled this out to the following week. So I'm now at a 250 strike, expiring 8/14, and I received another 272 credit. So all up, I have $4,677 in premiums collected. I have a safe strike. My 250 strike is above my 245 that I bought these shares at. And even if I let them get called away at 250, I've got $500 worth of capital appreciation there. That would take this total for one stock, one trade to over $5,000 in profit, or 21% in just, that'll be like 8 weeks, not even 8 weeks by the time this comes around. I hope you can see the power in this rolling down business, right? Because here's the thing, we just breached 240, which means technically my position is still underwater. I'm down by $500. Yet, even if I exited this now, I'd be up by over $4,000 purely because I sold these calls the entire way through, and importantly, I rolled them. Now, the stock that I'm talking about is none other than Credo. I've shared Credo with you guys a lot. I love it as an anchor position. Why? Because it trends up and it trends somewhat sideways for a while, right? I traded it all through here, through this dip, up through here. My shares got called away, hence I bought them back again at 245. We got all the way down here to 185. Do I care? No, I still made money the whole way through. Granted, yes, if I bought the shares down here at 185 instead of 245, I would be in a much larger profit now, but I didn't. And it doesn't matter. What matters is that I've got a strategy that I consistently can execute on. I'm not trying to time the bottom. Because here's what happens, right? The stock does get down here and people freak out. They're like, oh, I can't buy it, right? But if you've bought it and it's higher and you can just continue to sell calls and collect that income over and over and over again, you will be okay. Now, what's another great stock to use as an anchor? Nvidia is another great stock to use as an anchor. You don't get anywhere as high premiums, but it continues to give you probably $100 to $200 a week. So you won't get the returns that you get on something like Credo, but you will have a stock position that's quite secure. I don't know about you, but I don't believe Nvidia is going anywhere. It's one of my anchor positions in one of my accounts. And I just continue to sell calls week after week after week, doing that same rolling business. I roll it up, I roll it down a little, and I just continue to collect week after week after week this additional premium. Now, what do I do if we get 250 breached? Same thing. I roll up a little, I collect a little more premium, and here's the key. Look at this. I rolled up by $10 per share, and I still received a credit of $272. If I have to do that again, I'm locking in another $10 per share worth of appreciation. I'm locking in another $1,000 worth of profit if the shares get called away, and potentially another couple of $100 worth of premium. This is the strategy that I love the most when it comes to selling calls. So it is the kind of thing that we look at in more detail inside of the 50K Club. If you want to come and hang out in there, if you want to, talk to other people about your anchor positions and get some feedback and learn in more depth how all of this works, find the link in the description. But I do hope this was helpful to see the process of how do we actually roll and how do we make the most amount of money when the stock's going down? Because all of this is designed to reduce your risk, right? I'm not in this trade anymore at $245 per share because I've received a total of $4,600 in premium already. My risk keeps reducing the more premium I collect. And the only way we can do that I've found at least, is by selling covered calls. So I hope this was helpful, and I'll see you in the next video.